Yo. Yo. Me and my youngins. Man, a lot of these youngins, you know what I mean? Like a lot of these youngins, you know. Shit, man. I've been watching too much of the draft, man. I've been watching too much of the draft. I've been watching way too much of the draft, man. Yeah, I ain't, you know, I ain't trying to use no isms or nothing, but you know, you listen to the way, you know, these draftees talk, man. Yeah. I love Arvell Reese, bro, but damn. Arvell Reese, bruh. New York, bro. I'll tell you what, bro. Them YNs from New York. Everyone talks about Atlanta. Everyone talks about Chicago, Philly, Houston, LA. You know, they say we do it different in the Bay. But, bruh, them YNs from New York, bruh. Arvell Reese and Sonny. Wait, who the Jets draft, bro? Whoever the Jets drafted, bro. That number 2 pick for the Jets, man. That press conference did not go well, bro. Arvell Reese. Arvell Reese, bro, he had like a .04 or .4 GPA in high school, man. Oh man, apparently he turned it around. Had a 3.7 at Ohio State, higher than my college GPA at Arizona State. Uh, but these youngins, man, these youngins think they can quant. These youngins think they can quant. It ain't all the YNs, bro. It ain't all the YNs. Brandon Sorsby of Texas Tech. It looks like his football career is over. Looks like his football career is over. Gambling. Gambling. Oh, man. We're going to talk about gambling in this video a lot. These YNs, man. This guy made millions of dollars in the NIL. He made millions of dollars in the NIL, and he was betting $1 on live bets. He was showing up to baseball games and betting $1 per pitch on live bets at these baseball games. Oh, man, Brandon Sorsby, you know, hey, Texans, we got a little bit too much of our father in us. We can't put down the drinks. We can't put down the smokes. And, you know, some of us can't put down the cards. I stay away from gambling. But we're going to talk about gambling in this video because I've been talking to the boomers and I've realized something really important. Nobody. You know, when I was in college, The Wolf of Wall Street came out. Leonardo DiCaprio, he was doing Quaaludes. He was, you know, doing the blow. He was throwing little people at a dartboard, all this stuff, you know, hookers and fraud and all that with Jordan Belfort. The song Jordan Belfort came out. Oh, man, it was lit, bruh. It was lit, bro. We were at Arizona State getting lit, listening to Jordan Belfort, watching The Wolf of Wall Street. Crazy times, man. Crazy times. But, you know, the more I think about The Wolf of Wall Street, like Jordan Belfort, he ain't got shit. He ain't got shit. on the average baby boomer. Man, Brandon Sorsby, he's gonna be out for the year with his gambling addiction. He's checked himself into gambling addiction rehab, but you know, Brandon, you're a lightweight. You're a lightweight, bro. You're a lightweight. The boomers have been doing this shit, man. The boomers, they gambled their whole life savings through 2008. They gambled their whole life savings through 2001. They blew up in the dot-com bubble. They blew up in the financial crisis, and they just kept doubling down. They just kept doubling down, and now they got millions of dollars in their house and in the S&P 500, collecting less than a 2% dividend. And guess what? The boomers are going to win again, baby. The boomers are going to win again. 1, 2, 1, 2, 1, 2. The length of wave 1 places the wave 2 low, takes SPY to 840 before a shallow wave 4 and a wave 5 higher. If wave 4 retests the wave 1 high and wave 5 is the length of wave 1, places the wave 4 low, SPY is going to 902, baby. SPY is going to 902, and that ain't even the top. The S&P 500 is going to 10,000. The boomers are going to get another 30% gain on their wealth, man. They're the greatest gamblers in history. The Wolf of Wall Street were honestly made today. It'd be about some conservative baby boomer living in Texas, move out of the big cities into a suburb, and they'd live in a gated community. They'd have 700, 800K in their house. They'd have 1.2 million in the S&P 500, and these motherfuckers are letting it ride. And their social security, they got their social security, and that's kind of their safety net. And so they're telling all the young people, hey, just keep maxing out your 401ks. Don't worry about Social Security going away. What are you going to do? You can't kneecap them. We can't legally kneecap them. So we just got to respect the game. We just got to respect the game. Because, I'll tell you what, man. If Gen Z was following the stock market and millennials were following the stock market and they realized what the hell, like, bro, the boomers fleeced us. The millennials are mad about climate change. Gen Z's mad that we didn't deport anyone and that the politics are two wings of the same bird. Gen Z's trying to go back to Adolf, man. The millennials are trying to go back to Al Gore. But if you really watch what's been going on in the housing market, the boomers, they go into their HOAs. They keep saying, no more new housing, no more new housing, because they want to keep the price of their housing prices up. And, they're struggling to find someone to sell it to. But, on paper, they're rich. And this is the thing with the boomers. On paper, you're rich, baby. But the boomers, like, they don't realize they're addicts. They're gambling addicts. Like, they ain't making money. Like, besides that 1.5% dividend they get from SPY, all their wealth is on paper. All their wealth is on paper. I got this chart for the S&P, but what if it's this? What if we go to the pandemic lows? What if this is 1, 2, 3, 4, 5, and we're going to the pandemic lows? This is the marginal new high, the marginal new high that ends with Momo. I'm telling the boomers who follow me because I love the puffs, it ain't happening. SPY's going into the 900. So if you're a millennial, you're a Gen Z, we're kind of like Sorsby from Texas Tech. We kind of been forced into gambling. We've been forced into poly market. We've been forced into rain bat. We've been forced into Robinhood options, and they just removed the 25K minimum rule. You know, and if we're looking at this, you know, here's what I would tell the boomers. Here's what I would tell the boomers. Honestly, you know, you were lied to when they told you there's no free lunch. There is a free lunch if you invest in GPIQ, the NASDAQ out of the money covered call ETF from Goldman Sachs. If you invested $10,000 in that ETF, 10K turned into 14,275. If you invested that same amount of money in the YQQQ, which is the inverse of the NASDAQ, they track the exact same stocks. $10,000 turned into 8,475. That is a 13.75% total return. So a 13.75% total return in roughly a year and a half is risk-free. You can get 13.75% total returns in a year and a half, completely risk-free. If you do PTF, which isn't the same stocks, but it's tracking the best stocks in the NASDAQ, and it's rotating with the best stocks in the NASDAQ, $10,000 turned into 18,726. So you go to ChatGPT, and it'll tell you 18,726 plus 8,475 divided by 20,000 is 36%. So this isn't quite risk-free. This is a little, you know, now we're in kind of quant territory. You're longing the best stocks, the best performing stocks in the NASDAQ 100, and you're shorting the NASDAQ 100 index itself with an options overlay. You're getting paid dividends that are crystallized. I would argue it's pretty close to risk-free. On a scale of 1 to 10, 10 being no risk at all, 1 being extremely risky, I'd say this is like an 8.5 or 9. You long PTF, the best performing stocks in the NASDAQ. You short the NASDAQ with YQQQ. You're probably going to get a 36% total return. Probably. Now, if you don't want to take any risk at all, no risk whatsoever, there is a free lunch. GPIQ is Goldman Sachs NASDAQ out of the money covered call ETF. It's tracking the exact same stocks that YQQQ is shorting. YQQQ shorts the NASDAQ, GPIQ longs the NASDAQ. Your delta is 0. There is no risk whatsoever. You get 13.75% risk-free paid out with dividends. Now, if you want to get a little fancier, over the past 10 years, the semiconductor sector has outperformed the NASDAQ 100 by about 11% per year. The semiconductor sector has outperformed the NASDAQ by about 11% per year. So what you can do is that CHPY IPO'd. When did CHPY IPO? So the semiconductor sector in the NASDAQ 100, they have a correlation of about 65%. The difference actually comes historically from the semiconductors outperforming the NASDAQ 100. So instead of longing the best stocks in the NASDAQ with PTF and getting a 35% total return, you long CHPY from 4/3/2025 to now. CHPY turned 10K into 22,108. So you go to ChatGPT, you type in 22,108 plus, and we see what did YQQQ do. So the idea is, instead of picking the best performing stocks in the NASDAQ with PTF and longing those, you're longing the semiconductor sector, which have historically outperformed the NASDAQ by 11% a year with a 65% correlation. So you add the CHPY total returns to the YQQQ total returns. And this is where YQQQ is kind of an alpha ETF, because even though we see the NASDAQ at all-time highs, the YQQQ really doesn't lose that much money. So it's not too hard to find ETFs that outperform the NASDAQ, pay dividends, and what are you looking at? In just over a year, you got a 51% total annualized return. Now here's the thing. CHPY hit a new all-time high. CHPY exploded to a new all-time high. And by the way, if you want little less dividends, actually a lot less dividends, but you want even better total returns, long SOXY from Yield Max, long SOXY and short YQQQ. You long SOXY and you short YQQQ. You're taking the best stocks in the semis. There's less of a call override, so you're not capping your gains as much. You're getting fewer dividends, but you're getting higher total returns from capital gains from SOXY. So if we here, let's just look at SOXY, because this is a good example for Nvidia. SOXY targets a 12% dividend. So it was paying a 12% dividend when it was at 40, and it's still paying a 12% dividend when it's at 81. So the dividend rate stayed the same, but the total dividend doubled because the price doubled. And so this is where we're going to get into the magic of Nvidia. And this is where, a lot of people, Yield Max gets a lot of flack. Yield Max, to stick with the football metaphors, they're like Brett Favre. All right, Brett Favre, he's got some seasons, Brett Favre and Eli Manning. They got some seasons where they led the league in interceptions, but then they have some seasons where they're hot as fire. They make the playoffs with the wild card, and they just absolutely catch fire. They take a team that would have never otherwise won a Super Bowl, and they get them a ring. Yield Max, like, we like to give them flack for, some of the bad, but let's talk about some of the good. Let's talk about some of the good with Yield Max. I'm not too big of a fan with these, but let's just go through these ETFs. SOXY, banger. Tracking the best stocks in the semiconductor sector, targeting a 12% dividend yield, absolute banger. Now, we haven't seen a stock market super rally since Biggie, BIGY, came out, but I believe BIGY has the same potential as SOXY. You're going to track the best stocks in the market. You're going to get really good growth like SOXY during a bull market. We haven't seen it yet, though. I think Biggie is going to be a winner. 5E, I'll be honest, disappointing. It was supposed to run the Dorsey right. This is a good example of the number one rule. Why 5E is an example of the number one rule, FIVY. 5E ran the Dorsey right on all these ETFs. So the idea was that the best performing individual yield max ETFs were going to be the top 5 equal weight holdings of 5e. So in theory, it was amazing. If the Palantir ETF, the Nvidia ETF, the Netflix ETF, and the MicroStrategy ETF, and the ExxonMobil ETF were the best performing single stock ETFs, 5e was going to own all of those, and it sounded so good on paper. So the number one rule of quantitative investing is something can look good and sound good on paper. In theory, it can be amazing. In theory, something in finance can look amazing. But, will it actually play out? Will it actually work out? Let's go through some more of these ETFs. CHPY is a banger. It's tracking the semiconductor sectors. It's paying a 40 to 45% weekly dividend. It's hitting new all-time highs with the semiconductor sector. SOXX, which pays no dividend at all, has gone up about 125% since CHPY debuted. CHPY is up about 100%. Let's just get those numbers perfect. Let's just get those numbers perfect. SOXX, total returns since CHPY debuted, 141%. That's why I wanted to get the numbers perfect. CHPY, 110%, but it paid a 45% dividend. These gains are crystallized. Once a dividend is paid to you, you never have to give it back. Not even the banditos or the bloods can come knocking on your door and get those dividends back. Now, that's where I would say Soxy is kind of the best of both worlds. You got 114% total return, but you got a much smaller dividend and it was paid monthly. So I think Chippy's the best out of those ETFs because SOXX is great during a bull market, but if we snap our fingers and it's 2001, it's 2008, all those gains are gone. It was all on paper. CHPY, the gains got crystallized, and this is what the boomers don't understand. 1, 2, 1, 2, 1, 2. Wave 3 of wave 3. But let's just stick with Chippy for a little bit. CHPY is kind of an amazing ETF like SOXY because not only is the share price increasing with the outperforming semiconductor stocks, it's tracking the best semiconductor stocks in the market, which historically have been the best stocks in the tech sector. So if we keep seeing CHPY go up into the 90s, I still believe it's going to pay a 40 to 45% dividend. So this is what people don't understand. CHPY is a dividend growth ETF. CHPY is a dividend growth ETF. Now let me say some of the good stuff about Yield Max before we finish. There are some bad ETFs in here. In Yield Max's defense, the bad ETFs are almost entirely based on the underlying not performing very well. Fiat and CONY, for some reason, it doesn't seem to matter if Coinbase is going up or down. Both those ETFs kind of suck. ULTY is the biggest black eye for Yield Max. ULTY was a huge mistake. ULTY was terrible. In fairness to Yield Max, ULTI from Rex Shares and I think Curve, KYLD, they haven't done good either. So the idea that you're going to have your team stock pick the best high volatile stocks and sell options on them and pay a weekly dividend, that hasn't worked out for anyone. That hasn't worked out for anyone. But let's talk about One last great thing about yield max. Fiat, I just said fiat sucks. But if we look at WNTR and we look at dips and we look at my favorite, YQQQ, YQQQ, the truth that a lot of people are ignoring is that yield max has the best yield max has the best hedges in the entire market. I mean, we're talking about 30, 40 years of ETF creation history. No one has made better hedge ETFs than YieldMax. And this is why YQQ is so amazing. It's shorting the NASDAQ with an options overlay. So if you find an ETF that outperforms the the gains outperform the losses from YQQQ, you have free money. And that's why I just showed if you long GPIQ from Goldman Sachs and you long YQQQ from YieldMax, which shorts the NASDAQ, YQQQ shorts the NASDAQ, GPIQ longs the NASDAQ, you get a 13.75% total return. Pretty damn good. So CHPY is kind of an outlier. The stocks where yield max is physically holding the underlying stocks in a sector, those ETFs have done the best. Now, what yield max is trying to do, and I think this is really interesting, they're trying to solve these problems with a very interesting suite of ETFs. The balanced potential income. So MSTY gets you extremely high dividend yield. So does NVDY, so does TSLY. If we look, however, at the charts of these stocks, unless the stock is in a raging bull market, MSTY, TSLY, and NVDY are almost guaranteed to have NAV decay, which means they're almost guaranteed to have shrinking dividends. Doesn't mean you can't make money. You can still get more dividends than the ETF loses in value. You can actually do very well. And, we can show that during historical markets. But what NVIT, TEST, and MSST have the potential to do is they have the potential to dip with the stock and then recover to new all-time highs with the stocks, because NVIT, TEST, and MSST are only targeting a 25% dividend. The whole thing is that they are trying to track as much as you can the price performance of the underlying stock while paying a 25% dividend from a partial covered call strategy. We've seen this work with the Global X ETFs, QYLG, and XYLG, which run the half right on the S&P 500 and the NASDAQ. So remember how I said, if CHPY keeps going up and it keeps paying a 40 to 45% dividend yield, then CHPY is very quietly a dividend growth play. Now, GPIQ and YQQQ are free money. It's free money, completely free money. In a year and a half, you get a 13 to 14% total return without taking any risk at all. If you go 50% GPIQ and 50% YQQQ, I believe it's actually less risk than treasury bonds and collateralized loan obligations. Speaking of collateralized loan obligations, this is basically as close as you're going to get to free money without doing something fancy. People will say gold is a hedge, silver is a hedge. They're not really. They're not really. You look at what happened in 2011, and you're just, it's not really a hedge. Anyway, are gold and silver guaranteed to go up over time? Sure. It is KGLD from Curve, and KSLD from Curve. Are they very low risk? If your plan is to just stack silver and gold and be a silver and gold bug that lives off the dividends, yeah. If you want to take that risk, that gold and silver are probably going to go up over time. KSLV's paying 17%, KSLV's paying 25%, and they're doing extremely well in the total return category, but you're still taking that metal's risk. We haven't seen a treasury bond covered call ETF succeed yet. HYGW from BlackRock sells covered calls on HYG. That's the best performing. That's the best performing bond ETF. The best performing bond ETF, but it's high yield bonds. It's arguably not the safest. CLOZ, really, if you're not going to hedge at all, is the closest you're going to get to risk-free returns. Collateralized loan obligations on triple B rated CLOs. CLOs are generally safer than corporate bonds. You look at the chart of CLOZ, you're basically doing the dream. You're going flat, getting 8%. It's pretty close to risk free, but it's not quite risk free. And I think the closest thing to risk free that we have right now that's proven to work is 50% YQQQ, 50% GPIQ. It's absolutely risk-free, crystallizing dividends. GPIQ will outperform the gains from GPIQ, will outperform the losses from YQQQ. Goldman Sachs has found the alpha, and YieldMax has found the alpha. You're pairing two alpha ETFs together. This is where I want to talk about something interesting about Nvidia. So Nvidia, for my youngins, in late 2022, early 2023, I was screaming that Nvidia was about to explode off the map. It has since added 4.5 trillion in market cap since I said that. So on May 11th of 2023, YieldMax released NVDY. Now, what happened with NVDY, even though it recently hit an all-time low, it turned $10,000 into 42,382. So DIPS, the ETF that shorts Nvidia, had not existed yet. But we know that if NVDY had been paired with DIPS, in hindsight, there was risk-free money. In hindsight, there was risk-free money. NVDY would have turned $10,000 into 42,382. DIPS would have turned $10,000 into much less than that, but the lowest you could have gone was zero. Even if DIPS, the total returns fell to 2,000, 3,000, you're still looking at over a 250% total return, and you didn't take any risk at all. You didn't take any risk at all. One ETF long Nvidia, one ETF shorted Nvidia. So where does this take us? Well, let's get into some technical analysis real quick. Before we get into Nvidia, it's basically the same thing as SPY. It's basically the same thing as QQQ, and that's one good thing, about the semiconductors and about Nvidia, is that they're basically going to be tracking a major index. Now, that's important. Because if you try to do this with Bitcoin, Bitcoin has 80% corrections. It'll have 5-year periods where it goes sideways. It'll have a blow off top for 2.5 years, and then it'll crash down for 2.5 years, and it'll do what it's doing now. It's in the exact same spot it was in 2021. 5 years later, if you weren't collecting dividends in any way, you're scaling out at the top, you got flat money. Yeah, you got flat money. So we look at SPY 1 2 1 2 1 2, wave 3 of wave 3, shallow wave 4, in a wave 5 higher. The S&P 500 is going to 9,000. Book it, SPY is going to 900. We look at QQQ, very similar. 1 2 1 2 1 2. The length of wave 1 places the wave 2 low, takes QQQ to 788 before a shallow wave 4 and a wave 5 higher. If wave 4 retests the wave 1 high and wave 5 is the length of wave 1, places the wave 4 low, QQQ is going 200 points higher. So we look at Nvidia. In VIT hit a new all-time high too. I believe this is 1 2 1 2 1 2. You take the length of wave 1, you place it at the wave 2 low. Nvidia is going to 289 before a shallow wave 4 and a wave 5 higher. If wave 4 retests the wave 1 high and wave 5 is the length of wave 1, place it at the wave 4 low. Nvidia is going to 337, call it 338. So Nvidia is going to 338. You know, it's gonna go up about 1/3 in value, maybe more. Nvidia is going to 338. So we're kind of at a dilemma. We basically know if Nvidia goes on one of these rallies, we got risk-free returns. We can do 50% NVDY. We can do 50% DIPS. NVDY would have gotten better total returns than DIPS lost. And, you know, we're in Van Halen. We're in Valhalla. We got risk-free returns. One ETF longed Nvidia with an options override. The other ETF shorted Nvidia with an options override. One ETF turned 10K into 42K. The other ETF turned 10K into, we don't know, but it was more than zero. So we kind of know that NVDY and dips when Nvidia goes on these rallies is risk-free returns. And Nvidia is tracking the NASDAQ. It's the largest holding of QQQ and SPY the last time I checked. And so this is where, you know, we have to wonder, is it time to break the golden rule? Because like SOXY has doubled, and it's paid a 12% dividend with its increasing share price. So as SOXY has gone up, the 12% dividend has gone up too. So the whole kind of theme of this video was gambling. We don't have the back testing right now to show 50% NVIT paired with 50% dips is risk-free. What we do know, if you invested in 50% NVDY and you invested 50% in DIPS on May 11, 2023, you would have made risk-free gains. The thing is, NVDY is doing a complete override. It's selling as many call options as it possibly can on Nvidia. And so if we look at the chart of NVDY, it hit an all-time low when Nvidia had a correction. Now, if we look at NVIT, something much different happens. what appears to be happening, what appears to be happening is that YieldMax is successful. They have found a way, like SOXY, they have found a way to get a 25% dividend yield without overriding, without capping all the gains. If we look at just today, NVIT was up 3.38%. Nvidia itself closed up 4%. That's an 85% capture rate. So remember, as SOXY went up, it was targeting a 12% dividend. So the dividend also went up. SOXY was a dividend growth play. CHPY has also been a dividend growth play, but there's no target. I believe NVIT will be a dividend growth play. I believe Nvidia is going to 338, and I asked ChatGPT. ChatGPT said if NVIT maintains an 85% capture rate on Nvidia's price performance, it's going to be at $80. And ChatGPT gave its disclaimers, and it said, don't make too many assumptions, but it basically said that NVIT would be going to 79 based on today's capture rate, which to be fair was just one day. It said realistically it would have a 70% capture rate, which would take it to 74, 75. The whole thing is that if we compare NVIT to Nvidia, if we compare NVIT to NVDY, as soon as Nvidia had a correction, NVDY went to all-time lows, the dividends started shrinking, all that. I don't believe this is going to happen to NVIT. I believe NVIT will be more like CHPY, and it'll be much more like SOXY, which is capturing the upside gains of the semiconductor sector while paying a growing dividend. So the whole point of this video is I believe Nvidia is going to 338. The golden rule of quantitative finance is don't do something that looks good on paper until it's been back tested and proven. Here's the problem. If we wait for Nvidia to be at 338, here's a scenario we could be looking at. Nvidia is at 338. NVIT, the 25% target return ETF, NVIT has turned, let me find it. NVIT has turned right now, NVIT has turned $10,000 into 11,931. DIPS has turned $10,000 into 9,021. So we have close to a 1,000% gain and around a $1,000 gain on a $20,000 investment in half a year. What I believe is going to happen if we compare NVIT to NVDY, we see that NVIT is outperforming NVDY. What I believe is going to happen is that a year from now, at least, or at minimum, I should say, a year from now, Nvidia will be at 338. NVIT will be in the high 70s, and it'll be paying a 25% dividend paid out weekly, similar to how SOXY pays out a 12% dividend monthly, and it has doubled in price since the 2025 lows. So, what I think is going to happen, long story short, is that we're going to look back a year and a half from now, and NVIT will have turned $10,000 into $40,000 or $50,000. By the time we have it all back tested, by the time we know for a fact you can just load up NVIT and hedge it with DIPS risk free, it's going to be too late. It'll be time for Nvidia to go sideways. It'll be time for Nvidia to chop around. I believe that Nvidia is going to, over the next year, it's going to rip up to 338, have a shallow wave 4 correction and a wave 5 higher. What this means essentially, someone could take a very large position in 50% NVIT and 50% DIPS. DIPS might turn $10,000 into $5,000 or $4,000. But NVIT will go from 53 to 75 or 80, and it'll still be paying a 25% dividend. It'll turn $10,000 into $30,000 or $35,000. But unlike NVDY, NVIT will capture the gains. We won't see it hit all-time lows after a correction. So I believe that NVIT and a very risky thing would be to do this with the strategy ETF. I think strategy is about to explode. Wave 1, ABC, wave 2. The length of wave 1, place of the wave 2 low, takes strategy to 636. But we've seen, before Nvidia goes on these super rallies, you can get crystallized permanent gains without any risk at all from NVDY hedged with DIPS. So what I think is going to happen is that NVIT is going to be like SOXY. It's going to be like CHPY. It's going to be the gamble of a lifetime. You invest $10,000 into DIPS, that shorts Nvidia. $10,000 turns into $5,000 or it turns into $4,000. NVIT, I believe, will turn $10,000 into $30,000 or $40,000, and it'll be from 53 to 75 or 78. The dividend grows, and it's the trade of a lifetime. It's truly the trade of a lifetime.